In this video, traders, we're going to look at what does the spread mean. Stay tuned. Hey guys, warm welcome to you. Alright, so you've heard lots of people talk about spread, loads of brokers advertise tight spread, tight spread, tight spread, and that seems to be, a big angle that a lot of brokers are going towards. If you're looking for a broker, by the way, do check out our channel sponsors, a link in the description below. But the tight spread basically means for you and I that the cost is less to trade. I'll go through that in a moment, but let's just work out where the spread comes from. How does it all work? So if you can imagine two banks or two institutions, and one is a seller of an asset, one is a buyer of an asset. Now this could be a currency pair in the forex market, it could be a commodity of crude oil or gold, it could be a stock, could be an index future, any of these things. Now most have a centralized exchange, and we don't have to go off piste here and talk about that, but forex market doesn't. But ultimately they will get together somewhere and try to transact. When the buyer and seller agree, that's when a trade takes place. That's when we see the trade or the candle move on our chart, the price move on our chart, where the transactions taking place, especially when we're talking about centralized exchange. That's how it works. Forex slightly different, but we don't need to go into the different details of that. Just keep it relatively simple for now. Imagine you've got a buyer of an asset, seller of an asset, and let's just assume it is a currency pair. So this buyer here says, I want 15 minimum. So when it says I want 15 minimum, we can imagine that we've got this currency pair that's quoted at 110.15, maybe it's USD, JPY, something like that. So it's trading around there. And these guys are going to talk about, the last few digits of the asset they're trading, because they're executing large amounts, and this is the important digits they're looking at. Everyone knows they're talking about 110 because they're all looking at the same price. So looking at the same asset, these guys said, hey, I'm not going to take any less than 110.15. I want 15 minimum. This seller says, well, I want 16 minimum. I'm prepared to sell it, but I'm not prepared to go any lower than 16. We've got a stalemate. Buyer prepared to buy at 15, seller prepared to sell at 16. Now, when they enter those orders on the order book, and again, we're talking about centralized exchange or even a forex kind of order book, this is how it would look. It would sit there, it'd be 110.15 to 110.16. Now, there's always a volume component to that we don't have to get into. These guys might want to sell 100 million, these guys want to buy 10 million. Forget about that for now. The situation we've got here is they haven't matched, and so we've got the best bid and the best ask, or the best offer. The best price the buyer's willing to buy at, the best price the seller's willing to sell at. Now, if all of a sudden that seller said, you know what, I'll take 15, he would transact at 15, he would hit that bid, and the price would go through at 15. If it was a price change, it would adjust on the chart. As they don't, this is where we sit at the moment. Now, what happens is the difference between that bid, the best price that anyone in that asset is willing to buy at that time, at that moment in time for, is the bid, the ask. The difference between the two is the spread. In this case, it's 1 pip. If it was let's say if it was a stock, that would be 1 cent. If it was a futures contract, it could be 1 tick. The point is that it's the difference between the buy and the sell price. Now, that's the spread in the underlying market. And when we're talking about forex, we're not talking about 1 pip, we're talking about hundredths of a pip, we're talking about tenths of a pip, we're talking about sometimes there's almost no spread. We're talking about a stock, a cent generally is what we're talking about. We're talking about something like crude oil, for example. Again, we're talking about a cent spread. Now, when we transact, most of the time, if we're transacting with a CFD broker or a spread bet broker or any of these type of brokers, we are just taking the price that's offered. Now, we can open a direct market access account and we can kind of get involved in this order book and place orders on the exchange ourselves, but let's keep that apart for one side for a moment. Let's just kind of push that to one side for the moment. If we are an order taker and we're the broker is the other side of our trade, we are then offered this price. Now, the broker has to make money, guys. If this was the market price that they could buy at and sell at, they would have to add a little bit on. They would have to say, okay, we know what, we need to have a little bit more than that because we're not making any money. Now, ultimately, don't go into details about how brokers make money. They kind of make money generally, these type of brokers, spread bet and CFD, by becoming the market and being able to transact with buyers and sellers and making the spread in the middle. But ultimately, guys, the point is that when we're offered a price, we can see the buy and sell price, and the difference between the buy and sell price is the spread. That may well be on the underlying market, but what matters to us is the broker we're using and the spread they're offering for the instrument that we're trading. Now, you've got certain times of the day when the spread is going to be very, very tight. You can imagine when we've got a lot of buyers here, a lot of people, the market's not moving so much, the spread's going to tighten up in the underlying market, because someone might come on and say, well, I'm prepared to pay 15.5. Well, I'm prepared to pay 15.6. There's going to be a limit depending on the exchange of how tight that spread can be. But the more people that are involved in it, the less volatility, the tighter the spread is, which is why when you open an account with a broker, they might say, okay, during these hours, the spread is, 0.5 pips, for example. During these hours, it might be go to 1 pip, 1 tick, or whatever it may be. That's just because when there's fewer of these guys in the underlying exchange, sometimes this might widen a little bit. There might not be someone there. At the end of the day, if he's the only guy there and there's no one else underneath him until 10, he might go, well, actually, you know what? Why don't I just sit at 11 and wait for someone to hit me and make myself an extra 4 pips on this, rather than being so aggressive as sitting at 15. Whereas if he decides to lift that and there's lots of buyers there, he's going to go right to the back of the queue. So the quieter the market is, and the thicker the order book, the tighter the spread. When we have less liquidity overnight, sessions, stuff like that, goes thinner, the spread will widen. And also when the market gets very, very volatile, guys, the spread will widen. Because you imagine these transactions back and forth, the spread sometimes will widen right out as someone takes a 16, 17, 18s and sits there for a bit. Then someone comes in and fills that to 16, 17. So it kind of goes wide and narrow and wide and narrow, which is why some brokers will offer a variable spread and they'll kind of just match the market, the underlying market, and add a little bit on to kind of pay for their services, so to speak. Others will offer a fixed spread and kind of average it out over the period. But spread's important because what it means is if you bought at this price and sold straight away, you're going to lose 1 pip. And so the smaller that is, the tighter that is, the less your transaction costs are. And the lower your transaction costs, especially if you're trading frequently, you're scalping, or day trading, anything like that, that's just what you want. You want to keep those transaction costs low. Now, if you're swing trading, not so important. Difference between a 1-point spread and a 2-point spread. If you're doing 5 trades a quarter, pretty meaningless if you're holding trades for 1,000 pips at a time, but it becomes way, way, way more important and very, very crucial, in fact, if you're scalping. So one of the things you're looking for in a broker is a tight spread on the instrument you trade. Doesn't matter if it's tight spread on something you don't trade, but the instrument you trade, a tight spread during the hours that you trade. If you're going direct to the exchange, of course, you can join the order book and all that other stuff, and I kind of discussed that before, and maybe we'll do an exclusive video how we might do that if you're interested in that a later date. The important thing is, guys, spread is the difference between the bid and the offer. The tighter the spread, the better it is for you if you're just a transaction taker, if you're buying at 16, selling at 15. And that's really what you're looking for when you're trying to find a new broker. If you want to check out our channel sponsor, guys, a link in the description below. Take care, keep risk managed. See you next one. Bye-bye.